Hi, welcome to Challenge JP. My name is Jacek, and today I'm going to show you how to create a subscription model in Excel.
Let's start with the summary of the cash flow model, which should give you an idea of how the model is going to be structured. As you will see, there will be a few sections that we're trying to model here. First of all, we'll start with the subscriber numbers. The model assumes that you're dealing with a business that depends on subscriptions. So for example, it can be, let's say, a streaming service where you provide content to subscribers in exchange for a monthly recurring revenue. You will notice that the subscriber numbers, so this is the calculation of subscriber numbers when you start with the number of subscribers. You start with a 0, for example, in year 2003. You add a certain number of subscribers, then you will have some churn, which I will touch on in detail later on. And then we have the end of the year subscriber numbers. So that's the number of subscribers you will finish your year with. Notice that the model assumes you provide two type of pricing packages to customers. So in our case, would be a basic and premium package. That division, that split, will be then reflected in your calculations of revenues and costs. So you will have your basic and premium revenues calculation here, which will be then followed by sort of direct variable costs. So those will be the costs that are associated with servicing those subscribers. We'll have subscriber acquisition costs, which will be your proxy for your marketing spend. Then other variable costs. Again, I will go into those costs in more detail in later part of this tutorial. This allows you to then calculate your gross margin, and then that's followed with some calculation of your employee costs, some central office staff, and so on and so forth, and also your general expenditures, which then will take you to your EBITDA number. You will have some tax added to that, some capital expenditures like R&D or any sort of development costs that you need to include in your model, some working capital assumptions, and that eventually will lead you to your total cash flow, right? So the structure is very simple. You start with the revenues, which are derived from the number of subscribers that you're adding over time, and then you follow that with calculations of costs, gross margin to get to sort of direct contribution of your net revenues, follow with just central costs for the employees, general Opex, to get to EBITDA, and then some tax calculations, some additional capex, working capital, and so forth, which then will take you to a cash flow. The cash flow number here will be used to as a proxy to show you how much money do you need to raise in order to fund this model. So the model assumes that you will need to put some equity into equity investment in order for that business to run. We'll get to that a little bit later when we talk about equity returns, but basically that number here will be the driver of that equity requirement figure. Okay, so that's the main summary of the model. As you will see to your right, I've listed all the basic assumptions that we use in this model. Again, I will talk about them a bit more in detail as we're going into the monthly calculations. But just for example, you can very quickly see that, remember that split between the basic and premium revenues. This is where you can, for example, set your monthly fees that you charge to users. And the idea is that if you change any of those assumptions, this will automatically be reflected in the numbers to your left. So for example, very quickly, if I change this number to, let's say, $790, so that's the subscription that monthly subscription that customers charge. Let's see, at the moment it's set up to $690. If I just escape that, if I change it to $790, you will see that this changed those basic revenue numbers. Let me do it again. So you have a $690 here. That was your basic revenues, 113. Let's say in 2023, if you change that to 790, it changes to 130. Yeah, so that's the whole idea. That's why I actually brought the assumptions to the right of the summary page, not to have them actually in a separate sheet, because it just allows you to it just gives you this ability to see the impact of assumption change right away on the numbers. You don't need to sort of go back and forth between the sheets. And then I've also listed some of the main key metrics, financial metrics here at the top of the sheet, so you can see how the change in assumption affects the those numbers. But again, that's something that I'll talk a bit more about when we get to return on investment calculations and a bit of a sensitivity analysis, stress testing of the model. Okay, so now let's jump into the cash flow model itself. So that was the summary, and actually all the calculations that are taken into the summary, they're all taking place in your cash flow model. So the cash flow model is set up on a monthly basis, and the reason why I like doing that on a monthly basis is that that's probably as granular as you want to go. And then you can always, as you saw it on the summary page, you can always aggregate those numbers into an annual view. You may, for example, want to show the first 12 months of your forecast as sort of approximation of your budget on a monthly basis, and then maybe follow that with a quarterly or annual basis. Basically, having those monthly numbers allow you to aggregate your model as you wish. Okay, let's just jump into those monthly calculations. So just as I mentioned before, you start, the model starts with the number of subscribers. So at the moment, you will see that, again, we have that division between basic subscribers and premium subscribers. And again, basic subscribers are the subscribers that sign up to the your basic offering service, and then the premium ones would be a package with a bit of a higher pricing, right? So what we're saying is that we're starting with 0 subscribers at the beginning of the year. So the model assumes that everything starts from January 2023, blank slate. You have no customers at the moment. That's your month first of your business, and I'll get to those assumptions here later on, but you will start, you assume that your starting number of subscribers, you're adding 500 subscribers in your first month. Yeah, you see when I click on that 500 number here, if you look at the link itself, it links to that summary P11 cell, and then if you just look at the summary P11, that's the number over here, right? So everything is linked from your summary page, from your assumption table into those calculations on the cash flow model. It's important not to break those links. That's why I like to highlight any assumptions, anything that you would put as a user into the model in yellow, and then any numbers that are in border but without any highlights. Those are basically linked numbers, so you know that actually they're coming from other page, and you should not change those numbers here. They are linked to your assumption table in the summary page. Right. Okay. So we are starting with 500 customers, subscribers, and then what the model assumes that, okay, of those 500, divide this number between basic subscribers and premium subscribers using some sort of ratio. So for example, in our case, we're assuming that of the subscribers added in a given month, 70% will be basic subscribers, and then 30% will be premium subscribers. And that's reflected in the number here. You see 350, which is 70% times 500, and then you see 150, which is 30% times 500 as well. Okay, so that's our first assumption here, first calculation. Now, the model then goes into 2 metrics that will be quite important, especially when we're dealing with subscriptions, churn and retention. So we'll make some assumption here in the model that that I split into sign up or post-trial retention percentage and then a monthly churn. Now, there's a reason why I split those numbers into 2 sections. You may sometimes see models that simply just model one churn, but what you will usually see with the subscription models is that a lot of times a business will offer, for example, first month either at promotional price or maybe as a free trial, and then after that first month, you will be asked to renew your subscription or maybe provide the credit card details. Maybe you give the credit card details later on, but basically there will be an event when you need to decide if you want to continue subscribing to the service as a paying user, or if you just want to cancel the subscription and therefore not being charged, right? So that's a quite insignificant event itself, because obviously there's a difference between your behavior when you're paying for the subscription and when you have to when you get the subscription for free. So that first number here, which I call retention, you could also look at that as a sort of first month or second month renewal rate. That number determines how many of those free users that join that service, so those 350, will go into the second month of the service, okay, of the subscription. And I use the assumption here where if you have basic subscribers, let's say you would assume that 90% of the users will be converted to a second month subscription, and then let's say for the premium users is 65%, right? This is obviously just a guesswork. You probably want to have a bit of a data to do a bit of a data analytics on your existing subscribers. If you don't have any data, then it's probably a good idea to do a bit of a stress testing, sensitivity analysis, just to see what the numbers look like with different assumptions. And that's something that I'll quickly show as well later on in this tutorial. Okay, so that's your retention rate, and then that's followed with the assumption around the monthly churn. The monthly churn is just the number of users, the percentage of users, of your starting users that will leave the service by the end of the month, right? So those are the users that are converted, have been already converted to the paying users, and it's just sort of recurring rate of users that you expect to lose on a monthly basis based on the number of subscribers that you have. Okay, again, I'll get to that sort of visual illustration of how those numbers, how the churn numbers and retention numbers affect your customer lifetime value later on in this tutorial. Okay, so that's your retention, monthly churn, and then last assumption that I have here around the your user sort of migration. You can also assume that a certain percentage of users will upgrade their plan from a basic to premium, and then there will be also some percentage of users that will downgrade, will go from a premium package to a basic. Now that can be seen as a little bit more advanced assumption. So it may be the case that you just don't have enough data for that, and in this case you can just start with a 0. But if you see there's a bit of a migration, or you expect a bit of a migration from one package to another, upgrade or downgrade, you can probably put some number there as well, just to see how that affects your overall revenues and your costs and your cash flow. Okay, all right. So that those numbers here will then have an impact on your calculation of your final user numbers. So let's take the basic subscribers. You see that we've added 350 basic users at the end of the at the beginning of the month, and then looking at that number here, 90%, you expect that 90% of them will remain by the end of the month. So we have a 315 net adds. In other words, you have a 90% retention. You expect that 10% of them will not convert to a paying users, will not go into the second month of the subscriptions, right? So they just use, let's say, a free trial or a promotional trial or promotional pricing, and they decide not to, they cancel their service before you manage to charge them a fee, right? Or they just don't renew their service if you ask them, for example, to pay for another month. Okay, same calculation happens for the premium subscribers. So again, we have 150 users that join the service as the premium users. Here we assume 65% retention. So 65% times 150, that's rounded 98. Therefore, we know that 52 of the users have not renewed the service. Okay, and then we don't have any monthly churn, because remember the monthly churn only applies to the users, to the second month users. So if you're starting your service from the month number 1, you only looking at the retention rates. You will see that the monthly churn will kick in the second month. Okay, all right. So that 315 and 98 carries to those numbers here. You see there was no, we're not assuming any also upgrades and downgrades in the first month, because we just started the new service. So we wouldn't expect in the first month anybody will sort of upgrade and downgrade, right? I mean, as everything with the model, you make some simplistic assumptions. They don't necessarily have to reflect exactly how the users behave in a given month, but on average, it should give you a good idea. It should reflect the behavior of users using those metrics. Okay, and then you will see that that calculation lead us to 413 users at the end of the month, so the end of January 2023, which then those numbers are carried over to the beginning of the month. So we're starting now with 315 users from the previous month, 98 users. Again, those are the users that we retained. And then again, we're starting again with the calculation. We're carrying over. This time, I'm assuming I've built into the model a monthly growth for your subscribers. So you start with 500 users. We're assuming that you will have month-on-month growth rate of 3.5% for a period of time. So 3.5%, if you add 3.5% to 500, that results in 518 users, right? So you will see that progressively you're increasing the number of users that you add on a monthly basis over time, okay? And again, that 518, again, goes through that split, 70-30. So you're splitting those 518 users between your basic subscribers and premium subscribers using that ratio here. Again, we're going to apply our retention rate. So 90% of 362 is 326, 65% of 155 is 101. And then you also see that now we also calculate the churn. So the way the churn is calculated in the model, you take the start of month number of subscribers, and then you take 5% of that number. So basically what that means in practice is that you expect of all the users that you started the month with, that 5% of them will churn, will unsubscribe by the end of the month. So that's your loss, right? So you're losing 16 users of those 315, which is 5%. And then now you see also you have a bit of an basic to premium, so you have some upgrades. Remember that we assume that the upgrade percentage is 10%. So we're assuming here that of those 315 users, right, that you had at the beginning of the month, you adjust that number for any users that you've lost. So you had 315 users, you lost 16, so you have 299 users, and then you expect that 10% of those users will upgrade to the premium plan by the end of the month, right? So there's a 30. Again, the model uses a bit of a rounding, so sometimes you may see if you look at the expanded decimal points, you may sometimes see a number like 29.8 and so on and so forth. Again, that's just an average sort of approximation of the number of users that you expect in the model, right? And then same thing with the downgrades. So it's a little bit, you see there was a negative number here. So you expect that because you expect to lose the customers. So you will have a 98 users on the premium package. You lose 2 of them, and then you assume that 5% of that number, so 98 minus 2, and then if you multiply that number by 5%, you will see you expect that 5 of the users will move from the premium package to the basic, and that all those numbers here are then reflected into that final number of end of month basic subscribers and end of month premium subscribers. You just double click on the number, you see, okay, we started with 315 customers in your basic plan. You've added, so you return of the 362 users that you added in this month, in February, you retained 90% of them, so 326. That's the number of users that we'll add. We lost 16 of those users. Okay, so that's the number we'll deduct. And then so you have to pay attention to the signs in the formula here. You lost 30 users from the basic package because they moved to your premium pricing. So that's the number of users that you will see will shift from a basic to a premium package. But then you also had some downgrades from the premium to a basic plan. So that's the 5 will actually is the number. There's a minus here, so that's the number that you will gain as the basic subscribers. Again, if the downgrades and upgrades give you a bit of a headache, zero them out at the beginning because they're not probably as important to model as is the churn and the retention, and you will see we'll sort of ignore them later on. But again, it's a nice function to have just in case if you expect a lot of migration from one package to another. Okay, now when we have all those main numbers in place, and those were the numbers calculations that probably will take as a section most of the time, but it's important to set them correctly, because as you will see, they will be driving your revenues, your variable cost, and effectively your gross margin, right? So it's quite important to make sure that you understand and you set those subscriber numbers correctly, because then everything else, it's hopefully will be a bit more straightforward and linear from there. Okay, right. So let's just scroll a little bit up, and I'll be sort of jumping back and forth between the numbers, but you'll see that now we go into revenue calculations. The models start with the pricing assumptions. And one thing that you will notice is that I like to list at least most of the assumptions, or the ones that may change on a monthly basis. I like to list them on a month by month basis, right? So you can always see what pricing is being applied to a given month, right? And or what assumption, what either pricing or cost assumption, depending on what calculation you're looking at. And you will see in this case, remember, just going back to the summary page, we were playing with that pricing assumption for basic, or 690 to 790. So again, you'll see that number is linked to your summary page, P23, which is the number in here, right? So that's the your input. That's where the user or you will be putting the number in, and that number is then linked to the number over here. Okay, so that's your 690. Now, one thing that you will notice is that 690 is carried over until the end of the year, so December 23, and then there was a bit of an increase. That 690 becomes 707. Same thing with the 990 becomes 1015. I've built in a bit of an pricing increase assumption into the model itself. Again, that's linked to the summary page. So for example, in our case, we are assuming 2.5% increase on an annual basis. And that's a bit of an index calculation here. So basically what it tells you is that you take that number, your starting number, which was 690, and then you just multiply by that index here, which is just a way to basically saying take 690 and then multiply it by and add 2.5% to that base number, right? It's just a little bit easier to show it this way, because you just have to calculate one number by another. Okay, so that's your effective pricing. You will see that in this model, we're assuming that for your first month, so for your sign up pricing, it's there's a 0 in both premium and basic package, so that assumes a free trial effectively. And then you have those monthly recurring revenues, so that's a 690 or 990. Again, if you expect to charge the customers in the first month, you can input whatever pricing you have. If, for example, you don't make any difference between the first month and you don't have a trial period at all, or no promotional pricing, you can just input then 690 in that box over here. Or maybe if you have some sort of reduced pricing, let's say 50% off or something like that, you can put 390 or 290 or whatever pricing you will think is effective in a first month. Okay, right. So that's the pricing that we'll apply, and then you will see that revenue calculation should be relatively straightforward. So the way this monthly recurring revenue here is calculated, for instance, you take the have a look at that formula over here. So you take the F8 and multiply it by F59. So those are the cell references. F59 is that 690 over here, and you multiply that 690 by the number of subscribers that you start your month with. Okay, so it just assumes that you start with 600 customers and you charge them at the beginning of the month. Okay, now you may find some models that may take some monthly average or some other number. Again, that's a simplistic assumption, and it's probably good enough to calculate those revenues. So basically, it says, okay, you start with 600 customers; those customers will be charged your monthly recurring fee. And again, at the moment, it's a 0, but just to show you, there's a slightly different calculation for your sign-up subscribers. So in this case, you would take the row F58 over here, and then you multiply by row
F20, which is just the number of subscribers added, right? So this will assume that when you add a subscriber, this subscriber will be charged at your sign-up fee. At the moment, it's 0, but again, if it was a reduced pricing, it would just the model will apply whatever assumption you're using to those new subscriber number, and then in addition to that, you also charge your existing customers your recurring price. Okay, so that's the calculation, and it's exactly the same thing for your premium subscribers. So again, in the case of premium subscribers, to calculate the monthly recurring revenue, you will take that 990 assumption here and then multiply it by the number of subscribers that you see at the beginning of the month, the premium subscribers. And then for the sign-up subscribers, again, it's a 0, but in this case, just look at the calculation itself. You would take the F62, which is that pricing here, and then multiply it by the number of users that you add here for your premium package. Okay, and then basically later on, if we scroll down a little bit, you'll see that I just sort of summarized those revenues again, just repeated them, just to have them in one box, so you can see exactly how much revenues you expect or you forecast to see from those two kind of users, basic and premium package. Right. So now, once we've calculated subscription revenue, we can go to our variable costs, or sometimes I like to call them direct costs. Basically, those will be the customer costs that will link directly to either acquiring the customers or providing the service to the customers, which will be slightly different to the way then we calculate the general Opex. We'll get to that with some other costs at the end of covering this monthly cash flow model. Right. So you will see that, again, if I scroll up over here, you will see that I have two sections that I attach here to the customer cost calculations or assumptions. We will have a customer acquisition cost, quite an important metric, especially if you're dealing with subscriber models. Then we'll have some revenues, share / other variable percentage-based costs. Again, I'll talk to that or those calculations in a few minutes. And then some other variable cost. Again, which those will be based on the number of subscribers, but I'll get to those in a few minutes as well. Okay, all right. So that's our starting point. Again, all the assumptions here are listed on a monthly basis, and just as it was the case with revenues, with our pricing assumptions, I have also assumed that you have a bit of an increase. That's why you have that index, annual cost increase index. I'm assuming that those variable costs will increase by 2%. So you will see, for example, when if we go to the customer acquisition cost, I'm assuming that it costs you $20 to acquire a basic subscriber, and then let's say $35 to acquire a premium subscriber. But you will see that $20 will become 20.4. There's a 2% increase after 1 year. Okay, you can play obviously with this number, and again, that depends on what you expect to see or what your data potentially show. Okay, all right. So speaking of the customer acquisition cost, the way this is the assumption for your customer acquisition cost. The way I calculate those costs as a number is quite simple and quite straightforward. Basically, assuming that if I'm adding, let's say, in going back to month number 1, if I'm expecting to add 350 basic subscribers, and I assume that each of those subscribers will cost me $20, my customer acquisition cost will be $7,000. So that's 20 multiplied by 350. Okay, you can think of customer acquisition cost that you may wonder what exactly it is and how do you calculate it. Again, that's probably based on some sort of comparable data that you have. Maybe you have your own data. You can think of, for example, running a campaign on social media website or maybe on Google Ads, and usually you can track the number of clicks and the number of conversions, and therefore how much money each of this conversion will how much it will cost you to
generate that conversions, for example, which is a sign up to your services. So that this is where you will get that metric from. Okay, and that's why I put it in variable cost, and I sometimes do like to call it a direct cost, because there was a direct correlation between the number of subscribers that you added and the cost and with what it will cost you to add the subscribers, acquire the subscribers. Okay, same thing for the premium subscribers. Again, we're on the month number 1. We're assuming that premium subscribers here will be a bit more expensive to acquire. So let's say $35. And again, I'll take this $35 and just multiply by the number of premium subscribers that I added in month number 1. And that will give me 5.2 thousand. Okay, that will bring the total cost to 12.2. So simple as that. And second month, same calculation, the number of new customers added times your acquisition cost. Okay, so that's your first calculation here. So that's driven by the number of new customers. Then we have a section with the revenue share, right? And that's the percentage revenue share here that you can see in here. So we're assuming that you may have maybe content provider, maybe a third party that you have to pay out a portion of your revenues to. You could also use that assumption to, for example, model even your payment processing fees. For example, if you're collecting all the payments through credit card provider or credit card processing party, payment processing party, they expect a certain percentage of those collection to go to them as a cost. So that's why I call it the revenue share / other percentage variable cost. The most important thing to remember about that calculation is that this one, while the customer acquisition costs were driven by the number of new customers, this cost is simply driven by your revenue number. Okay, so if we are assuming, for example, we're in March at the moment, if we are assuming that your revenue share is 10%, which is the assumption over here, and your revenue from your basic subscription is 4.141, then 10% times 4,141, that's 414, right? So there's a very straightforward calculation. Again, as mentioned before, the way I try to build this model is to start with just the main subscriber numbers, the main drivers, which take a little bit of time to set up, but that makes it a little bit, that goes into the revenues and then it goes into a cost. So it makes it a little bit easier to follow the flow once you spend a bit of a time on setting the model correctly. Okay, so you have that flow. So again, I take my revenues and then multiply by percentage. My revenue share percentage in this case is 10%, can be any number in here. And then for the premium users, for example, assumption here is 30%. So I'll take the revenue, premium subscription revenue, and then multiply it by 30%. Okay, simple as that. And that will give me $1,071 of the cost in total. Again, remember that this is just those numbers are fictional. Any of the assumptions can be much bigger, much smaller. I mean, I try to put a bit of a logic here where you see that, I assume that premium subscribers, are a bit more costly, but they also generate more money. So just to have a bit of a logic in here, but you may find it's always important to do a bit of your own research and also look into, the data that you may have, or maybe you can get some data from, some comparable data that you can use to model your subscription business. Okay, and then the last but not least, I've also included a section for other variable customer monthly cost, and that is simple calculation. So this is the calculation that is driven based on the total number of subscribers. Okay, so there's I've built in a little bit on purpose 3 different ways of calculating those customer costs. So the first one, acquisition cost, is driven by the number of new customers. The revenue share is driven by the revenue number. And then the last category here is driven by the number of customers, which we then multiply by just a fixed per customer fee over here. Okay, you will see that fee also increases on a yearly basis. But for example, you can assume that to maintain or to provide the service to every customer, on average, it costs you 50 cents.
Now, what this can be anything that you need to pay to provide, maybe to a third party to provide a customer service, maybe some hosting costs, licensing, and so on and so forth. Okay, it's just an average number. And the way this number is calculated, again, you take that assumption. So in our case, it's 50 cents, and then you multiply it by the number of your subscribers at the end of the month. Okay, you could change it to the beginning of the month. You could take the average, but again, it's just to sort of show you that just in a simplistic way, if you have 1,000 subscribers at the end of the month, you would assume that will cost you, if you assume that it costs you 50 cents to provide the service to an average customer, if you take the number of customers and multiply by that number, you will get to $552. And then again, if you repeat the same calculation for your premium subscribers, you take the number of subscribers, which is 529, and then you multiply by our assumption here, which is 150. That will take you to 794, which in total will give you a figure of $1,346. Okay. Now I've summarized that again here in our box. Summarize those variable costs in our box here. So you can see that I'm just adding the three numbers for the basic subscribers, and then for the premium subscribers over here, that's my total number. And then at the end of that, I calculate the gross margin. The gross margin, the way the gross margin is calculated here is simply it's calculated by taking the revenue and then subtracting from that revenue variable cost, right? So let's look at the first line, basic subscribers. You had $5.9 thousand of revenues from our basic subscribers, but our cost was $8.9 thousand, just a little bit above that. So you actually end up with negative 2,964. Okay, you'll see that that negative will quickly turn into a positive number, but that's something that we can address when we discuss just overall cash flows. Same thing for the premium subscribers. So you take the revenues from the premium subscribers, which is the subscription revenue here, 5,239, and then you subtract from that number your variable cost, which is here. Okay, and that gives you the overall gross margin, and that completes the sort of your customer revenue and cost calculations. Sometimes you may see that gross margin may be called net revenues. I mean, that I think while the definitions are important, I think from the point of view of the modeling, I think what's important to remember is that in our case here, this number is just simply the revenue, the customer revenues minus those customer variable costs. Okay, now let's finish the last few sections of the monthly calculations of this on our cash flow model, and we'll finish with a cash flow, monthly cash flow figures, which then will take us back to our summary page, and this will allow us to talk about equity returns, equity requirement, cash flow injections, a bit of a scenario analysis, and then we can also discuss quickly the customer lifetime value calculations, which again will be based on all the figures that we discuss here. So hopefully by the end of this tutorial, you'll be familiar with all the terms and all the numbers that are being used in this model. Okay, all right. So I'm just going to scroll down here. Now, I built in so you'll see that majority of the model is taken by, I think there was a whole sheet that basically was dedicated just to the calculations of the customer numbers and the churn and retentions and so forth, which was then followed by another sheet with your revenue calculations, and then another section with the cost calculation, customer cost calculation, and then we have a slightly smaller section for any staff costs or employee-related costs, any general Opex, and then some tax calculations, some R&D, and a bit of a working capital here, and then the cash flow. Okay, number. So you will see that the main focus is just getting those customer revenue, those subscription revenues and subscription costs correctly, and then we just put another layer on top of that, and that should be sufficient, right? As everything with the modeling, you can obviously add more rows to that. You can add more detail, but it's all one thing is
important to keep in mind is to keep just the right balance. If you have too many details, there's also, there's too many sensitivities, too many variables, there's too many things that you need to change. So it's always important to strike sort of the right balance between the detail and necessity of having so many, so many things in the model. Just remember, it is a forecast, so it's supposed to give you a good idea of how your business, how your model will behave on certain conditions. But it's at the end of the day, it's still an estimate, it's a guess. Now, for our headcount calculation or for staff calculation, employee-related cost, I make very simple assumptions. I'm assuming that just to run this business, you need an X number of people. So you need some central staff, you need some finance people, you need some management probably, you probably need some admin, and so on and so forth. Okay, so I just simply say, okay, let's assume we're going to have 10 people from the beginning of the model, right? So this is that headcount section. Again, you see that number here, it's linked to that summary P32 cell, which takes us to, which is taken from that yellow box in employees number in the summary page, and that number 10 is then carried over to the remaining months. Now, there's also the annual salary increase assumption. So I'm assuming that we expect this the annual salary will increase on a yearly basis. Okay, at this model, we set it at 3%. And you can see reflection of that assumption here, right? So I'm assuming that, okay, you have a number of, you have your headcount number, number of employees that you expect to hire. You have those employees will be paid at average salary cost of, in our case, 4.2 thousand, right? Again, it's an average. Somebody will be paid more, somebody will be paid less. Hopefully, everybody would be, paid more, but you never know. Then you have your also some other assumptions. I made some assumptions around office costs. So you will see later on that I actually I calculate or I forecast the office cost as the function of number of employees and average office cost number. And then there was some other cost per employee. So other cost per employees could be any overheads, any insurance, and any other costs associated with having those employees on board. Okay, all right. So those are the assumptions. Again, everything listed on a monthly basis on the top of the section. So you can then quickly see, you see that salaries calculation here of 42,000. That's the calculation of simply is derived simply by taking the number of headcount, which is 10 employees, and then by multiplying it by this assumption 4.2 thousand. So that comes to 42,000. And then your other employee cost, again, remember you had 1,050 for other employee cost. That's calculated by 10 employees multiplied by 10 employees. So that's 10,000, right? So you just take the average cost and then multiply it by your headcount, and that brings you that cost to 52,000. That's basically it, right? You can expand that potentially into divide into different roles, but again, we try to give a bit of a simplistic, that the main focus of this model is more on those customer revenues and cost than sort of the central office here, right? But if you were to expand it, for example, if you wanted to show different functions, you would just add more rows in here and also have a different average salaries for different roles. But you would follow exactly the same logic, same calculation. Just take the number of employees and then multiply it by your average salary, monthly salary for that specific role function, for that specific role or specific function. Okay, and then office, I'm assuming here. So now we're getting to general Opex calculation, and I'm assuming that Opex is calculated as the average cost per employee. So it's the number of employees, which is 10, and then that's being multiplied by your average office cost. So that's 5,000. And the reason why I did that is just in case if you increase the number of employees to 20, that increase in the number of employees probably should be reflected in also your office cost, right? You wouldn't expect to have the same office cost for 10 employees and then for 30 employees. There has to be some sort of function. You could model that sort of manually, but it's nice to have something that's a bit more dynamic and more responsive to the number of in this case, for example, to the number of employees. Now, speaking of some of having sort of a fixed cost, I've also put costs such as general Opex, IT, and contingency, and that's simply just a fixed number, monthly number here, which is 2,000 in our case, which comes from the assumption from that summary page, and then we multiply it by just that index, so we increase that by 2% over time, right? So this is just sort of a fixed cost that you expect, any cost that you expect to have by running the office on a monthly basis. And then I also put a bit of a contingency. Again, that contingency is a fixed number. You could put, for example, a percentage of revenues as a contingency, or have a bit of a play with this model. But again, we try to be as simplistic as possible in that section of the model itself. Okay, and that now, so with all those numbers added, we have 10,000 here. For example, August, we have 52 in our employees cost. So you will see that with those numbers here, I can calculate EBITDA, right? Which is gross margin minus the employee cost minus the general Opex, right? If you haven't seen the EBITDA before, haven't met this term, it means earnings before interest, tax, depreciation, and amortization. Okay, so that's basically your earnings before any additional sort of charges like tax. And you will see in this model also it does include things like capex and so on and so forth. So that's a term that you will probably, if you haven't seen this term yet, you will probably encounter that somewhere in your financial modeling life. Okay, all right. Now, very, very quickly, let's go to the other costs. So we have some estimated tax in here. You see there was no tax until we start hitting some positive numbers with our net income. This tax calculation also include depreciation calculation and so forth. So it basically, what it does tell you is that we are assuming 20% in this case. It just assumes that once you start generating a positive net income, you need to assume that you have to start paying some tax, right? When you generate losses, we don't have to pay any tax out of that. But when you start generating some income, you probably can assume that. Now, again, this is a simplistic assumption. There's different ways. You can probably have another section on modeling the tax, and there could be some tax breaks and some all kind of accounting treatment that you can use to calculate your tax. We're not focusing on that here. This is sort of not an accounting course, but it's quite important probably to stick some this calculation into your model, not to forget about it, right? Okay. So that's your tax calculation. Then you have I've plugged in R&D development cost. So for example, if you're running a software-based, or you're providing some service that's running on platform, you probably have to expect that you will be, you will keep developing that platform on an ongoing basis, or maybe, which is the case here, you may also have a case where, maybe that cost here will be just spread over the first few months. So for example, when you're building a new, when you're designing a new software and you're spending some money, especially when you're outsourcing that, you would expect some development cost in the early months, and then maybe that's followed with a smaller expense later on. Now, if you're in accounting, if you look at this model from an accounting point of view, there was a different accounting rules as to how much of your expenses you can put into capex and how much of that you have to put in the operating expenses. We are mostly focused here on cash flow anyway, so in a way, it doesn't matter where you put it, but just in case if you care more about accounting, again, that's something that you probably have to check with accounting rule just to make sure that you reflect it correctly, okay? And then there was a bit of a working capital adjustment. So there was a bit of assumption here when you see this payable and receivable movement that, for example, with the payable, that you don't have to, if you have a certain expenses in a given month, you can assume that, you will make the payment. Let's say there was a 30-day payment term, so you can delay some of those expenses to the future month, which may help you a bit with the cash flow. And then also on the the receivable side, so on the revenues that you receive, you may expect that maybe not all of the revenues that you booked in a given month will be received in this particular month. So this is the calculation here. It is part of the cash flow model, working capital, so that's something that's important to model. But again, it's probably worth just making some simple assumptions here, not to try to overcomplicate it, unless you have a huge expenses at the beginning of the month. For example, like this development cost that you think you can delay it to later months, then this is probably worth spending a bit more money. Sorry, a bit more time on, as this will affect the overall cash flow. So now we've covered EBITDA, and we have those additional costs like tax, capex, working capital, which then takes us to our total cash flow. And the total monthly cash flow, which is calculated here, that's basically your estimate of how much money you will receive, taking all the revenues and deducting all the expenses, all the outflows from your model. Also, how much money you will receive, or if it's a negative number, how much money you will need to spend. And therefore, you'll see I've added that cumulative cash flow calculation here. So this just adds those numbers on a cumulative basis. And the reason I do that is that peak, see this number here, is increasing. It's getting more negative, so it's decreasing over time. And once you sort of hit that peak, you see it peaks at 1.8, somewhere around here. So 1.853. That's sort of the break even here number, and then it starts going up. That's going to be a proxy for how much cash do you need in order to fund your business, which is again something that I'm going to address in the next part of this model. Okay, so now we're back to our summary page where we started. Hopefully now this table makes a bit more sense. As you can see, I've aggregated lots of the costs and numbers into smaller categories just to make it more presentable. You probably, when you design a summary page like that, you probably want to keep in mind that you want to, paste it into maybe a presentation. So you sort of want to keep in mind the visual side of how you're going to present those numbers, right? So in our case here, I did the annual view. I have an annual view of the numbers. So you start with 2023, you finish with 2032. So it's a 10-year model again, and it just summarizes all those categories that we discussed, but in again more sort of condensed form. If you interested in how I've aggregated those numbers, and remember I also mentioned that you could potentially show them on a quarterly basis, on monthly basis. I like to use sum if formulas over here. So you see, if we just double click on the formula, you'll see that I'm using the sum if formula. So I'm summing as a sum range. I use for example, in here is that row 77 from a cash flow model, that monthly cash flow model sheet, which is which are the revenues for monthly revenues for a basic package subscription. And then so that's my sum range. And then as a criteria, I use, for example, in this case, 24, and then the criteria range is that row number 5 in the cash flow model sheet, which is a row here. So you see that I've listed year and month for each of the period, each of the column, which then that will allow me to aggregate those numbers and use those sum if formulas. Yeah. So again, this is one of those things where it's quite important to think of when you design the model. Usually it's a bit of a back and forth. You may start putting some numbers first, and then just work on the functionality of the model. But that's a nice way of setting it up, because it just allows you to quickly aggregate those numbers, and potentially you could change those numbers here, and this will automatically adjust those annual figures. Okay, but the bottom line is that our total cash flow is presented in here. All the revenues, costs are presented here on those annual basis, and then you have your cumulative cash flow here as well. There's a bit of a check here. So it says, luckily it says true. Basically checks whether that cash flow number here agrees with your monthly cash flow, right? So the idea is that you should add those numbers. So you should aggregate those numbers from the monthly cash flow model, but then you should add them. For example, when you calculate EBITDA, you should sort of add them independently of each other, and you should get to the same answer at the end. The answer being the cumulative cash flow, right? So how much money do you expect to generate in total over that 10-year period? And that should agree your monthly figure. Your figure from a monthly model should agree with this annual figure in here. Okay, now when we're on this cumulative cash flows, very briefly, I just want to touch on calculation of returns, right? Because I mentioned that before, that this cumulative cash flow will be a proxy for your investment. I had a bit of here's just a calculation of what do you expect in terms of the your deficit or surplus in cash. The important thing is if we start from the beginning of the table here, so I've just summarized sort of the main numbers. So for example, you take that EBITDA number. So this is, remember, your earnings before interest, tax, depreciation, amortization. I've also summarized some numbers from the cash flow from operations, cash flow from investing, cash flow from operations. You see exactly what numbers are being linked here, but those are basically just your cash flows that you receive from your revenues deducted by a cost in proxy. Investing is any cash flow from investing is any in our case is all the numbers that are going to this capex here, your development. So that gives you the figure of your cash flow before financing. And if you see that number being negative, that means that you need some cash in order to fund your model. And you see that cash, that number being repeated here. So this is your cash flow deficit. And what this will do, if I just move those numbers actually down here, just do that very quickly. With those numbers here, you will have this will give you an idea of, okay, how much equity do you need to invest over those next 3 years. And then if you look at the last year, you have that exit proceeds calculation. So this is exit proceeds, or sometimes you may hear about terminal value of the business. That's basically the proxy of the valuation of your business at the end of year 10. So the way I calculated that number here is by simply taking the EBITDA and then multiplying it by 10 over here. This 10 number here is just the we call it the EBITDA multiplier. So it's something that you use to it's one of the method of valuing a business. If you're generating 1.6 million in earnings, this company is worth 60 million, right? It's just 1.6 multiplied by 10. In addition to that, you may have some assets as well. Like, for example, you may have a cash in your bank account. And then eventually this allows you to say, okay, if we were to, for example, sell the business, you will receive all the shareholders will receive 21.6 million or 21.7 million in cash, right? Again, it's just a forecast, it's just an estimate. It's not something that, it's a sure thing, but it's just sort of a simulation of how much money, you can expect based on certain assumption, by exiting the business, by selling the business. With those numbers here, so with all the investments and all the valuation in here, you can use Excel's formulas to calculate the IRR and NPV. So the IRR is your internal rate of return. You simply take your investments and then your valuation, your exit value, and use the IRR formula to calculate that number. And then for the NPV, again, you take the NPV and then take the discount rate, which is here 20%, and this will give you an idea of how much money in present value your business is worth. Now you see that with those metrics, equity requirement and NPV, are linked to the top section of the model. And the reason why I did that is because now I want to do a bit of a sensitivity analysis, a bit of a stress testing of the model itself. So what I mean by that, I want to see, okay, well, how a change in an assumption affects my model, right? Or in other words, how sensitive my model is to a change in different assumptions, right? And you should usually pick just few
few assumptions from your model and play with that, and especially the assumptions that you're not quite sure about, that you maybe don't have enough data to support. That's probably the assumptions that you want to test, and just to see whether it's going to break your model, or how profitable it's going to make this model, or whether if there's any negative impact, what that impact is, right? So in the case of the model itself, the model that we're working on, subscription model, one thing that for sure going to make the model sensitive is the pricing. So very quickly, we've done it before, but let's do it again. Let's change the pricing from $6.90, and let's actually go down. So let's see what happens if you go from a model of from a pricing of $6.90 to, let's say, $3.90. Okay, I haven't hit enter yet, but pay attention to those revenues here. For example, last year revenues for your basic subscription, it goes from 1.5 to 870, and you see the IRR so your returns went from 34.3% to 23%, right? So there's a drop in your return. Now, whether it's a significant drop or not, that's a judgment that you then have to take, or your investor have to take. But also look at the number here. So the equity requirement after the drop in price is 2.4 million, and before was 1.8. So that means that if you drop in price, you will need $600,000 more in funding, right? That's probably the most sort of significant number if you're trying to estimate your equity requirement. Let's look at another number here. Again, we're just focusing on basic subscribers, but you can do the same thing for premium ones. Let's double our customer acquisition cost from 20 to 40, right? So you should see a change in those acquisition costs here, right? So 334. Boom. Okay, right? So again, that number has changed. And also look at the IRR and equity requirement. Yeah, that number went. So your IRR, it's very similar to your pricing issue. So you went from, we had 1.8 million for your equity requirement, right? And that number has changed to 2.4 million. So again, a quite significant increase. And then your IRR also changed. Now I'm going to just highlight it so we remember which assumption we've changed. And let's combine those two assumptions here. So we're going to have a $40. So we're going to increase our customer acquisition cost, and then we're going to decrease the pricing. And look what it does to the model. Now you will see that your equity requirement now went to 3.4 million from 1.8 million. So that almost doubled that equity requirement. You will see your IRR drop, so your return dropped to 12% from 35, 36% that we had before. And then your NPV is actually negative because you're using that 20% discount rate. Okay, well, last but not least, let's restore our assumptions to where they were before. And we talk about equity returns and equity calculations and so on and so forth. And now I want to talk very briefly about customer lifetime value calculation, because that's something that's also important when you try to measure the profitability of your business. So you have a simple calculation here that takes you should be familiar with those assumptions from our previous discussion, which is the retention number and the monthly churn, right? So that's 90% and 5%. And then you have the sign-up fee, and then your sort of recurring subscription fee, right? So this is $6.99. We'll come back to that number at 18, but this allows you to calculate your customer lifetime value. So those are the revenue side of the customer lifetime value. And then we have some costs associated with taking also from the model, which is that customer acquisition cost, revenue share, and then other cost, which is this. Again, I'm using the numbers that we use in the model. So that allows you to calculate sort of the cost side of our analysis. And that in effect will give you
the customer lifetime net value, right? So you take your revenues 125 that are generated over the lifetime of the user. Again, I'll come back in 2 seconds to that 18 number, and then you deduct all the costs that you generate during the lifetime of the users, and this will give you the customer lifetime net value, right? So the idea is that you're adding a user, and on average, you want to see, okay, well, how much money this customer actually will bring me, right? And this is where the churn and the retention and churn numbers will be quite important, because the higher the churn or the lower the retention rate, the shorter will be the lifespan of the user, right? So if I increase that 5% to 10%, I can expect that the lifespan of the users will decrease, and so will the customer lifetime value. Okay, and you can see that here, just looking at that calculation to the right. So what this will show you is just takes the a cohort, so a group of users that, let's say, we've added in month 1, just 100 users for simplicity, and you see what happens to those users, to the number of users, as the time progresses, right? So that's the month 0 here is the number of users that joined in the first month, right, of the service. So you see 100. Now we know that we expect to see a drop of 10%, so we retain 90% of users. So you see that 100 becomes 90, and then of those 90, moving forward, we expect that of the number of end users, right, in this month, we expect that 5% of them will drop, right? So that 90 becomes 86, and then of the 86, you expect that again 5% of them will drop. So in other words, we retain 95% of them, 5% will drop, and then again you see a 5% drop here, 5% drop here. So that by month, let's say 36, yeah, by month 36, using those 90% retention and 5% churn, you expect to only retain 15 users, right? If I look correctly here. Yeah, 15 users, right? So you're losing quite a lot of subscribers over time because of the churn, right? Now, you see there's a whole calculation here where you take those numbers of users that that are in the service and the number of users that churn, that left, and then you calculate, okay, well, of the numbers that left, if you take the numbers of users that left and then divided by the number of users that initially joined, so the 100, that gives you the percentage number of users in a certain vintage being how old were those users, how long they stay in the service before they left, right? And then you just multiply this one number by another, and you add it together, which is done over here. There was a sum product formula that basically does it in one step, and this allows you to calculate that 18-month lifespan, which then fits into this part of the calculation. And then, for example, you see, I just take the my sign-up fee and then multiply that $6.99 by 18, right? Because average lifespan of the user is 18 months, so I expect 18. I take 18 months times $6.99, so this is the revenues that I expect to get from those users. I do exactly the same thing with similarly with the cost. So I'm assuming that, okay, well, every user will cost me 20 in acquisition cost, because this is one-off cost. There will be some. I will have to pay the revenue share of my revenues of 10%, so that's that $12.5806. And then I will have some other variable cost, which is 50 cents per month. So over 18 months, that's $9. So I'm expecting to see a $41.6 in cost. And that, if you take that revenue deducted by, subtract that cost from this revenue, you will get to 84.2 net lifetime value, customer lifetime net value. Now, speaking of sensitivity of the churn, if I increase that monthly churn to 10%, see what happens to our graph and then to our calculation, right? So it's 84 net. See, that significantly dropped, and you see how you can see that drop being reflected. Those users are dropping much quicker than with the 5% churn, right? So you have quite a big impact, yeah, of churn on your customer lifetime value, which again you can show in this graph, and then you can also see it's being reflected in your revenue. So for example, if you double your churn from 5% to 10, your customer lifespan or lifetime becomes 9 months, which then obviously that affects your overall revenues because you only multiply your revenues by 9. Same thing with costs, so there are lower costs, but ultimately your net lifetime, your customer lifetime net value does decrease. So that shows you how significant, how impactful, how significant those churn numbers can be on your model, and it's certainly something that is worth testing your model for, and something that it's good to spend quite good portion of time on making sure that you're putting some sensible assumptions.
I hope you enjoyed this tutorial. If you have any questions, please go to my website, www.challengejp.com. If you would like to download the template used in this tutorial, go to the description of this video where you will find a link to my blog. Thank you very much.